Next guest says investors should have some patience with the market. Joining us right now from Austin, Texas is Don Yacktman. He is President, Chief Investment Officer, and founder of Yacktman Asset Management, which manages close to $4 billion in assets. By the way, he was recently voted a finalist for Fund Manager of the Decade by Morningstar. And we should point out his Yacktman fund has beat pretty much all of its peers over the past 5 years. So great track record. And Don, great to have you back with us. So let me ask you, how much patience do investors need, and why?
Well, I think as contrasted to a year ago, we think of the market as being like the stock market being more like a bond market. And a year ago, the spreads opened up dramatically between high quality and low quality. And so taking a little more risk was really merited. But today, in effect, the spreads have narrowed dramatically. And so I think one needs to be very patient and in effect, have a lot of high-quality businesses in their portfolio. Our top holdings, for instance, are Pepsi, Coke, News Corp, and Viacom. Excuse me.
I wonder, we've seen, obviously, a huge run-up, almost 73% now since the lows this year, this March, I should say, a year ago.
Right.
Does it take a lot of value out of the market? I mean, are you finding new investments harder and harder to come by?
Well, it's just been a shift. It's been a shift away from things that have more economic sensitivity toward things that are just more predictable. And I mean, like Clorox and Procter & Gamble, Johnson & Johnson, Comcast. I mean, you look, we're just loaded with those kind of investments. Whereas a year ago, one of our big investments was Americredit. Now it's a much lower percentage of our assets because that has a lot more economic sensitivity. But the stock's almost gone up like 8-fold. So it's just a dramatically different environment today than it was a year ago.
And Don, I know when we talked with you in early February, you said, you'd like to see the Dow fall about another 20%. I mean, that makes sense. You're a value guy. You're looking for some greater value. You'd like that to happen. How likely is it, though, based on the fundamentals and kind of the backdrop that's out there?
We just don't try to predict that. I'll just tell you we love volatility, and when the market drops, think of it as being like a storm coming through and hitting a fruit tree and some of the fruit dropping to the ground. Gives us a chance to analyze which ones we want to pick up.
I feel like if quality were an industry, it'd be the most popular right now because a lot of people have been saying that lately. But where are you finding the most value in industries? I mean, is there a certain group that you think is still substantially discounted?
Well, again, I've alluded to that. I mean, we put our money where our mouth is, so to speak. So Pepsi is just an enormous holding for us. It's over 10% in our focused fund.
And
so,
media,
I mean, that gives you an idea.
And media as well. But, you've liked it for so long, Don. I mean, you like News Corp, Viacom, Comcast. Are they still undervalued, or are these investments that you're just holding on to because you think they have a long way to run?
They're good investments, but they're not spectacular investments like they were a year ago. That's the difference. I mean, today, I think on a forward rate of return basis, most of what we have, I would say, will provide low double-digit type returns. But I think that's well in excess on a risk-adjusted basis of what's out there.
Don, let me ask you, because Morningstar recently did a ranking of 10 funds that invest like Warren Buffett. Your fund was at the top of that list. I'm just curious, they made this comparison. I'm curious, though, how much you do look at the strategy of Warren Buffett and incorporate it into your own strategy.
I think good investors, and particularly value investors, stand on their own 2 feet. A lot of times we find that Warren Buffett is where we are after the fact, so to speak. So we aren't trying to look at what he does and then try to emulate him. But I do think Warren Buffett has a tremendous track record, probably the best capital allocator of the last 50 years.
And you both like Coca-Cola big time. I know that's one of your top 3 positions. Warren Buffett's liked it for many, many years. Coca-Cola, though, recently did a big deal, and they bought up the North American bottling operations, brought them back in-house, similar to what Pepsi did. Also, good strategy in your view, or what do you think? Or time will tell?
I think it was somewhat of a defensive strategy. It gave them more flexibility because I think soft drinks in the United States are probably peaking and growth is minimal. Remember, Coke makes about 80% of their earnings overseas. But this gives them the distribution ability to sell a lot of different kind of products through their distribution channels. which allow them to pick up more growth in the United States and have less of the, I don't know, I would say problems of not necessarily competition, but just differences of interest between the bottlers and the syrup maker. But I mean, I look at, like, you come back to Buffett, we like Pepsi, and he's used Kraft, a lot of Kraft stuff. You know, I just think Pepsi is a lot better value than Kraft is.
All right, hey, Don, thanks so much for joining us. Always a pleasure to have you on the show. Don Yacktman, there of Yacktman Asset Management. We have to